We recently analyzed the niche materials manufacturer Park Aerospace Corp, and today we pivot to Smith&Wesson brands. This company is a long-standing U.S. leader in firearm manufacturing, primarily operating through its firearms segment with brands like M&P and Gemtech.
Indeed. And the discussion around Smith & Wesson right now is absolutely fascinating because the underlying data is, it's profoundly contradictory. We are looking at a company caught between years of, sustained historical decline and these enormous expectations for a sudden, dramatic short-term turnaround.
Right. That tension between past performance and future expectation is exactly the core of our analysis today. So we frame the central question this way. Given the immense external industry pressures and volatility, does Smith & Wesson's strong near-term earnings forecast and robust balance sheet signal a genuine undervalued turnaround, or is the current valuation simply unsustainable due to deeply rooted poor operational efficiency and negative long-term performance trends? I'll be arguing that the fundamental liquidity and that aggressive future growth potential provide compelling support for a positive, more bullish outlook.
And I'll be arguing the alternative, that the market is placing, frankly, too much faith in near-term projections. The historical declines, coupled with underlying margin weaknesses and deep structural issues inherent to the industry, suggest significant fundamental risk remains that the current stock price just cannot sustain.
Okay, so when we examine the company, it immediately screens as a potentially compelling value proposition relative to its assets and sales. It's trading at a price-to-sales ratio of 0.93 and a price-to-book of 1.21. Now, those are metrics often associated with undervalued companies, but we really must look forward to understand the current price action.
We certainly must. The market isn't just hoping for improvement here. It seems to be demanding it.
Precisely. And that demand is pretty much baked into the numbers. We see a forward PE of 22.27. This valuation is based on an expected, get this, 151.89% growth in EPS next year, leaping to about $0.45 from the trailing 12 months EPS of only 0.27. Now, this growth trajectory isn't just a wish. Arguably, it's achievable because it is underpinned by an exceptionally strong foundation, the balance sheet. Our current ratio stands at 5.21.
A remarkable number, I grant you that.
It is. A current ratio of 5.21 and a quick ratio of 1.37 demonstrate almost unparalleled liquidity in this sector, providing a rock-solid ability to manage short-term obligations, weather industry downturns, or, importantly, fund necessary improvements. Crucially, the company's leverage is low with a debt-to-equity ratio of just 0.36. Furthermore, recent reports confirm the company is achieving market share gains, suggesting management is successfully executing a strategy to capture sales even in this restrictive environment.
That robust balance sheet, to me, acts like a very glossy exterior masking a deeply corroded operational core. We have to look past the cash reserves and examine profitability.
Which you find lacking, I take it?
Absolutely. The current trailing PE ratio is high at 36.55. That figure is completely disproportionate to the company's current reality. The profit margin is only a meager 2.57%. But the most concerning metric for me is the return on invested capital, or ROIC, which sits at a tiny 2.46%. This implies that for every dollar the company invests back into its business, be it inventory, machinery, or product development, it is generating almost no profitable return.
And what does the historical picture show then?
Well, the historical performance is devastating, frankly. Sales over the past 3 years are down negative 18.10%, and EPS over this same period is down a shocking negative 58.14%. We cannot simply dismiss years of fundamental decline and operational weakness based on a single forward projection. And furthermore, we really must talk about the dividend. The payout ratio of relative to earnings is 174.03%. That is deeply unsustainable and signals that the company is paying out far more than it earns, likely draining its reserves just to maintain shareholder expectations. So let's focus on the sustainability of that 151.89% projected EPS growth. I just struggle to find it credible when the industry is facing noted headwinds, weak consumer spending, inflation, tariffs, and when the trailing 12 months EPS has already dropped negative 63.58%. This isn't just historical decline. This is recent profound weakness. Until we see genuine evidence of a structural change in operational efficiency, a forward estimate based on such massive percentage growth looks more like hopeful speculation than a reliable forecast tied to reality.
That forward estimate is supported by two critical factors: execution and professional confidence. The estimate likely incorporates the very recent news of the company not only topping Wall Street expectations, but more importantly, successfully gaining market share. This suggests management is taking aggressive action, not just passively waiting for, the macroeconomic tide to lift all boats. They seem to be actively taking sales from competitors.
But where are those market share gains coming from exactly? And crucially, are they sacrificing margins just to move units?
Well, the gains suggest successful execution in their core firearms segment, likely driven by certain popular product lines, perhaps like the M&P series. And the professional consensus seems to support this belief in execution. The analyst consensus RECM score is a bullish 1.67 with a target price of $12, which represents a 20% upside from the recent close. That forward PE, I think, reflects sophisticated confidence in the turnaround story, moving from deeply depressed earnings to perhaps a more normalized level. It's essentially a bet on the management team delivering on operational improvements. Now let's tackle the operational efficiency versus liquidity debate head on. Yes, margins are thin. The gross margin is 26.76%, I acknowledge that, but we cannot overstate the value of the balance sheet in this specific scenario. That current ratio of 5.21, which, means the company holds over $5 in current assets for every $1 of current liabilities, coupled with the low leverage, it essentially gives the company a massive, secure war chest.
A war chest they seem reluctant to open, apparently.
Not refuse, perhaps, but rather one that provides the necessary runway. This financial stability is absolutely crucial because it allows management the time and capital without severe financial strain or immediate bankruptcy risk to make the necessary, maybe even painful, investments needed to improve those very operational margins you're highlighting. Liquidity buys time for transformation. It is a fundamental safety net that, frankly, most companies in turnaround scenarios simply do not possess.
But have you considered that robust liquidity can actually be a sign of stagnation, particularly in a potentially declining industry? The company's sitting on a huge pile of cash and inventory, sure, but the ROIC at 2.46% indicates that capital is being deployed, inefficiently. If they truly believed in a turnaround and needed those investments you mentioned, why isn't that capital being used more aggressively for, say, R&D, streamlining factory processes, or better inventory management?
So you're suggesting the liquidity is more a symptom of poor capital allocation rather than inherent strength?
Exactly. A current ratio of 5.21 combined with operational margins below 5% simply means they are very liquid while being fundamentally inefficient at their core business of turning raw materials into profitable firearms. The assets might be safe on paper, but they are generating minimal return. That 2.46% ROIC must drastically improve before the high current ratio becomes a genuine indicator of future performance, not just a historical snapshot of reserves built up during potentially better times. Furthermore, we really have to look at market sentiment and structural risk, because these factors heavily influence the sustainability of the current price. We see high volatility metrics for the stock noted at over 4%, and technically the stock appears overbought, trading at an RSI of 71.66 following 20.71% jump in just the last month. This rapid movement looks driven more by short-term speculative excitement over a single earnings beat, rather than evidence of a sustained fundamental recovery.
Or perhaps that excitement is just the market finally correcting the extreme undervaluation we saw over the past year or so.
Not entirely, I don't think. I look at the structural risks inherent to this sector, which are completely missing from those balance sheet metrics. You have regulatory risk, brand perception issues in a politically charged climate, and shifting consumer demographics. These all pose immense long-term challenges. These issues likely contribute to that high volatility and explain why institutional investors might still be deeply skeptical. I mean, look at the short float, the percentage of shares being shorted. It remains significant at 7.34%. That implies a substantial portion of, let's say, informed money still believes the fundamental risks outweigh this projected turnaround.
I'm not entirely convinced by that line of reasoning, mainly because the stock has spent years being arguably sufficiently de-risked. The stock was down over 36% over 5 years. The upward pressure we are seeing now feels more like an overdue adjustment. You focus on the volatility, but I focus on the analyst community seeming to recognize a shift. We saw Lake Street, for instance, upgrade the stock to buy recently, raising their target to $13. And regarding the dividend, which you rightly point out has a 174% payout ratio, that's high, no question. But I'd argue this might be a strategic move. Management could be using the balance sheet strength, the very liquidity you question, to signal confidence to long-term shareholders and maintain some return, even if temporarily expensive, to bridge the gap until the higher EPS growth potentially materializes next year.
It's an expensive signal, yes, but it might be intended to maintain investor loyalty during this turnaround phase.
It's a signal financed by capital that I would argue should be deployed to fix the fundamental ROIC problem. It feels a bit like robbing Peter to pay Paul.
Or perhaps it's using the existing capital structure prudently to facilitate market confidence, which is often a key component of any successful turnaround. So, to summarize my perspective, the investment thesis here is really built on the combination of fundamental liquidity and anticipated execution. The strong balance sheet metrics, that 5.21 current ratio and low debt, provide the necessary security and flexibility. When you layer on the market's high expectation for that 151.89% EPS growth next year, which seems supported by documented market share gains, you have, I believe, a clear, credible path toward justifying the current valuation. If management continues to execute and converts those sales into better, more profitable returns, the stock could be entering a multi-year recovery phase right now.
And my summary remains one of significant caution. The core debate really hinges on trust. Do we trust a single, very aggressive, forward-looking estimate over years of documented operational decline, deeply low capital efficiency shown by that 2.46% ROIC, and a structurally unsustainable dividend payout ratio of 174.03%? While the balance sheet is undeniably liquid, the company remains highly exposed to ongoing industry headwinds and significant regulatory risks. The recent price spike still appears driven more by short-term excitement than fundamental change. And until that ROIC metric shows real, sustained improvement, I think the market needs to remain skeptical of any deep, enduring fundamental recovery.